In this video, we're going to talk about Paysafe, trading under the ticker symbol PSFE. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before, and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Paysafe is a startup operating in online payments with the branches of storage and payment products for both individual and commercial clients. It is the parent company for applications that we know like Squirrel, eCash, and NetTeller. Its offer of value is to facilitate users to exchange money online. The appeal of the market is that Paysafe is a company recently introduced to the stock exchange and therefore should attract more attention, which should translate into more trading volume and to an extent influence its future performance. Its stock price is fairly volatile, which may provide excellent opportunities to make gains by selling at the right moment. Like many other companies in the same era, Paysafe seems to have a following online amongst the retail traders who are willing to be patient with it, even to increase the investments in time despite the decreasing stock price. The market cap of Paysafe is currently at $2.58 billion, with an enterprise value at $6.52 billion. The market cap is the price tag financial market is willing to evaluate Paysafe at, with a consideration to its future potentials and the current fundamentals. The enterprise value of the company is the net result of the company's assets when all the debts are paid off. Usually the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged or the company may be under selling pressures. The quick ratio of Paysafe is 1.12. The current ratio is 1.12, and the debt over equity is 0.86. The average trading volume of Paysafe has been 12.84 million shares, and recently the daily volumes have been 7.9 million shares, 23.07 million shares, and 8.7 million shares. The one-year beta of Paysafe is 2.94. Its 52-week high is $19.56, and 52-week low is $3.18. Now, let's also talk about the options market for Paysafe. In terms of volume and open interest, the options market seems to favor the call side. Generally speaking, the put options mean that the market expects pullbacks, and the calls options mean that the market expects the prices to move up from where they are right now. The key strike prices where there seems to be the most volumes are $3.50, $4, and $4.50. Paysafe has seen its stock price falling ever since it was introduced to the stock market a few months ago. The main reason behind it is because the company's valuation has been lowered after releasing disappointing quarter results. In a way, the company is allowing itself to test the patience of investors to see where they're willing to support the company and where the bears are willing to bring the company down to. I believe that the stock is currently building its support around the $4 level, but there is not enough time to determine whether this is an actual support or if it's just a small pause before the sell-off continues. Please keep in mind that the previous slowdowns of the downturn may last for up to 2 months before they continue to go lower, and this time it may not be different either, so we really have to wait and see. So I think that the trading strategy, if you're willing to take the risk, is to wait for some support to be confirmed and then keep a small position in Paysafe, and then to see whether the next quarterly results would be better, and more importantly, whether they can allow the company's valuation to be modified upward. This would genuinely change the share price of Paysafe for the better, and in terms of exposure, I would suggest the maximum exposure to be kept below 0.5% of your portfolio. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks when shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.